Hello, this is Rex Crandell, and today we're going to be covering the general subject of wills, trusts from start to finish. And more particularly, this section has to do with the tax consideration of wills and trusts and estate administration. We're going to cover a lot of tax forms, informations, procedures, technical material in the hopes to make the subject matter understandable. My background is I've got over 40 years of tax preparation, over 21 years of estate and trust practice. I'm registered as an attorney, a CPA, IRS enrolled agent. I'm enrolled to represent taxpayers before the U.S. Tax Court and Franchise Tax Board and EDD. I'm a principal in a firm, Rex Crandell Firm, and we do wills, trust, and estate planning and administration. And then on the CPA side, we do tax preparation for individuals, partnerships, estates, trusts. And we have a YouTube channel called Estate Planning California, Rex Crandell, where we have a lot of educational material. So the tax considerations of estate planning. There are quite a few pitfalls related to estate and trust administration that are easily navigated if you have the awareness of the rules and the forms. Um, it's essential that you have an attorney that understands the tax issues as well as the legal issues um, relating to estate and trust administration. Sometimes I see situations where the firm doesn't have tax information or experience, and they may have real good legal background and experience, but the tax area they leave to someone else, and sometimes it falls through the crack because maybe they're just saying get tax advice from somewhere else. So the tax problems can beset you and cost the client quite a lot of money. First off, what happens in estate administration? We're talking now about post-mortem estate administration. And the person passes away sometime during the year, and they still have a tax filing requirement for all the income that was received from January 1 through the date of death. At that point, what will happen is the banks will usually freeze the accounts, open up another account for the estate or trust, and the IRS or correction, Social Security is notified about the death. The tax preparation for a decedent who dies mid-year, it's still due on April 15th of the following year. Unless you file an extension, then you can extend the tax filing due date on the final 1040 uh, until October 15th of the following year. When a final 1040 is being prepared in the upper right, you always write uh, the word deceased on the upper right of the tax return, so IRS knows they're working with a decedent. And the executor, administrator, trustee will sign the tax return with the taxpayer's name and then put by uh, Susie, trustee, uh, or John Jones, executor. After the date of death, you will end up needing to get another ID number for the estate and trust, just so we're clear on the different terms. When somebody dies and owns assets that are not in trust, they're owned personally in their own name, those assets are called, it's called an estate with an executor or administrator, depending on what the probate court says. And then when there's a trust and someone passes away, the person is called a successor trustee. Um, you we file for a new ID number with the IRS, and after the IRS has authorized and issued the new ID number, then a new bank account is created to handle the assets, and the investment account holders like Charles Schwab, Merrill Lynch, they're all notified of the new federal ID number, and they will most likely be issuing a new account number for the investment account that they're in charge of. The form number to get a federal ID number is called the SS4, and that form can be filled out online, or it can also be filled out in paper and sent to the IRS, and a few weeks later you'll get them back. We usually fill out the forms online from our office and get the new federal ID number immediately, along with a letter from the IRS stating that this is the ID number and that they're looking for a tax return, which is an IRS Form 1041, by April 15th the following year. And the IRS it's so common and it's not difficult to get the new federal ID number. When you're handling a state or trust administration, one of the first factors to consider is there a possibility of inheritance tax or gift and inheritance tax? That is a form, IRS Form 706. We've done many of them over the years in our office. When I started, the threshold that we would need to file one was at 625,000. Presently, the threshold of assets that require an estate tax return is 14 million dollars for one spouse, and another 14 million for the second spouse before you need to file an estate tax return. So that's quite a lot of money, and if you don't have that much in assets, then there's no requirement to spend any time on that tax returns. I find that oftentimes educational programs overemphasize the estate tax return, IRS Form 706, and go into it in great detail when there's less than 1% of the population will ever need to file it. The amount of tax above that 14 million per spouse is at 40%. So it's significant when it has to be paid, and the estate tax return has to be filed within 9 months of the date of death, or you can ask for an extension of time to file, and IRS will grant that. So here's the threshold, 13.99, I call it 14 million. And then starting in 2026, that exemption per spouse drops back down to $7 million per individual, or 14 million for a married couple. And above those, this is market value of the assets, so you need appraisers and revalue the assets based on those appraisals. The form itself is called a 706, and it doesn't matter if you have a trust or a probate or no trust or intestate. The IRS form is actually called U.S. Estate and Generation Skipping Transfer Tax Return. The penalties are quite high if you owe tax and do not have it filed on time, or not paying the tax. The form, there are several pages to it. Some of them get quite thick. You've got the gross assets. You list all the assets on attached schedules. You list the information regarding The details of the assets, the types of assets, this is only the first page. And most firms will have software that prepare these tax returns for those trust and estates that need it. Some with that exemption from 14 million per person, if someone wants to and one of the two spouses dies and they don't use anywhere near that amount of exemption, the 14 million, let's say their estate was 10 million per spouse. Uh, at that point, the surviving spouse can file an IRS Form 706 inheritance tax return. And then they had an exemption of 4 million that they did not use. And that's called portability when you file an IRS Form 706 with no tax due, just so the surviving spouse can add it to their exemption or threshold. So before the estate tax is due. By that I mean, say there's like my example was 10 million, the surviving spouse could have had 14 million before inheritance tax was due. So that extra 4 ends up going and being transferred to the survivor. So the survivor started with 14 million, and with the extra 4, now there's 18 million before the inheritance tax starts. A very severe impact for non-citizen spouses is the inheritance tax of 40% starts above value of assets transferred to that non-citizen spouse of 175,000. So anything above that small number, the surviving spouse who's a non-citizen will have to pay the inheritance tax, estate tax at 40%. And it doesn't matter whether the non-citizen spouse is a resident alien, non-resident alien, just the fact that they're non-citizens. I think the government was worried people would inherit the assets and then take the money out of the country. We have a type of trust that we use to reduce the impact or defer the tax for non-citizen spouses as beneficiaries. It's called a qualified domestic trust, abbreviated QDOT. Qualified domestic trust has to have at least one U.S. trustee, assets in the U.S., and then when the assets are taken out of the trust, the inheritance tax is applied to the amount of distribution, and so the full amount of the inheritance tax is deferred. There's another form related in this area. It's called a gift tax return, IRS Form 709. This form is needed to be filed when in 2025 when there's a gift of greater than $19,000 to any one beneficiary. So a person could give 19 million if they had 5 kids, they could give 19,000, I said it wrong, 19,000 as a gift. Before they would have to file a gift tax return. If they had 5 kids, they could give 19 times 5. And then when husband and wife are giving gifts, they can give up to 28,000 per beneficiary because both spouses can give that amount. And the purpose of the gifting is to get the money out of the estate of the decedent. And the gift tax return keeps people from breaking the current rule. Like John D. Rockefeller gave away all his money before his death. There was inheritance tax at the time, but he circumnavigated that by giving away all his money. You can do that still, but you're limited to smaller amounts. And each time you give more than 19,000, you have to file gift tax return, IRS Form 709, and that reduces that exemption that we were talking about previously, presently at $14 million per decedent. Next, what's the difference between estates and trusts? A estate is created upon death. A trust is created during life, with the exception of one testamentary trust that is created in the probate court. But most of the trusts that we see today are revocable, changeable trusts. And most often these trusts become irrevocable on the death of the trust creator. And if you have a trust, you can avoid probate on those assets. In California, if you have a decedent's estate greater than 184,500 of market value of assets, then you're required to go to the probate court and do a probate. It might take a year and a half, 2 years long. It might cost $30,000 to $50,000 in attorney and executor fees. And it delays the processing, probate creates a lot more paperwork, legal forms, where trusts are a lot easier to administer after death, but there is still work to do after the death of a trust creator in transferring the assets into the name of the beneficiaries. There's a new law for 2025 where if the decedent had a principal residence with a market value of 750,000 or less, then the new law allows that to be transferred without opening a probate case in the probate court. That could save time for certain situations. The estate tax return, as I mentioned, is required to be filed within 9 months of the date of death. If it's not extended, all assets at market value are included in the estate. The gift tax form is the form IRS Form 709. Our office teaches a class on court accounting. This is the kind of accounting that's used for trust and estates. We offer it through the Contra Costa County Bar Association, and this is free. It's a 3.5 hour course. And we teach people how to do court accounting, which is completely different than business accounting, and it's needed for all probate actions, and it's needed for trusts reporting information to beneficiaries if they are either demanded to do an accounting by a beneficiary, or if their trust has had a case where they needed to be into the probate court. That course can be signed up for by calling the Contra Costa County Law Library at area code 925-655-4627. And I teach the class with my colleague, Tamara Brown, who's a legal document assistant. When you have an asset, let's say a house that you bought for 200,000, and now you're going to sell it at 2 million, generally there's a large capital gain. However, because that property could have been subject to estate tax, the IRS Code Section 1014 allows you to get what they call a stepped up basis at the date of death to the fair market value. So let me give you an example. If you had a house bought for 200,000, now you sell it for $1 million, you'd have an $800,000 capital gain. If somebody owned a house that they bought for 200,000 and they sold it after death, at death, the value for tax basis would increase to $1 million. So if the house was sold relatively close to the date of death, the gain is going to be eliminated because the cost now is $1 million and the sale price is $1 million. And after real estate transaction costs, it would likely be a loss and not taxable. You want to avoid giving property or putting property in beneficiaries' names before death. That will cause quite a bit of income tax potential being distributed to the beneficiary. It's much better to wait for the settlor of the trust or the property owner to have the property distributed to the beneficiary after death because of reduction of capital gains purposes or capital gains requirements. When you're doing estate and trust administration, there's an IRS form 8971, and the trustee or executor needs to give this to the beneficiaries if a property was distributed to a beneficiary. So in our house example, if the $1 million house was transferred to the son and daughter after death, now they would need to know when they sell it what their tax basis in the property would be. And that's what this form does, is it informs the beneficiaries their tax basis, because otherwise they would not know. And there's each individual beneficiary gets this side 2 page with the particular asset that was distributed to them. We call this kind of a distribution in kind distribution rather than selling the asset and distributing the cash. And oftentimes it's, especially in California, it's not advisable to sell real property because of the property tax implications. And so that you just transfer the property in kind directly to the beneficiaries. California has no estate or inheritance tax, but they have a salient hidden estate tax in the form of increased real property tax. What that means is, let's say you had a property with a house that somebody bought for 200,000, now it's worth $1 million, and the settlor of the trust dies, the property gets reassessed, and then the property tax gets increased, sometimes, as much as $10,000 a year, just because of the death of the settlor. And that, to me, seems like an inheritance tax. When we're doing a trust and estate and trust administration, and so the settlor dies, they're usually the trustees, so we file affidavit of death of trustee with the county recorder's office, along with a certified copy of the death certificate, and that will remove the trustee's name from the public record and put in the new trustee's record name, who's going to be in charge of managing the property from that point. Additionally, when a settlor dies, the form change in ownership, death of real property owner needs to be filed with the county assessor's office within 150 days of death, notifying the assessor of a possibility of an increase in property taxes on that parcel. There's ways that you can reduce the increase of property taxes to the subsequent owner of the property if the house is distributed in kind. And in this example, let's say that mom lived in the house and then mom dies and the house is transferred to daughter. Daughter now lives in the house, and you can claim an exemption from reassessment or increase in property tax because of a parent-child exclusion. And this is not filed with the county recorder's office like deeds. This is filed directly with the assessor's office in the county where the real estate is located. And is another exemption if the property was distributed in kind between a grandparent and went directly to a grandchild. Then the property tax can remain lower because of the exclusion. The only caveat here is the requirement of the law that the middle generation not be alive at the time of transfer between grandparent and grandchild. The middle generation are the parents. There's also an exemption from increase in property tax for co-tenancy. Boyfriend, girlfriend living in a house and one of them dies, then you can claim the exemption between co-tenants living in the property. We've been talking about the California Proposition 19, which narrowed the parent-child exclusion. It was much more liberal before, but through a deceptive proposition, the way it was worded, tricked the voter population and created millions of dollars increase in property tax. The parent-child exclusion can only take place if the parent lived in the house and had it as his principal residence and had filed a homeowner's exemption, which is another form with the assessor. The homeowner's exemption says, I'm living in the house. They give you a minor reduction in assessment value for property tax of $7,000, and that might save you $55 a year in property tax. But what it does is it establishes the principal residence for the parent child exclusion. Okay, so tax filing requirements for the final 1040, the normal individual tax filing requirements. Before you have to file a tax return, it's around 18,000 for single, around 22,000 for married. After death, from an estate or a trust, if there's $600 of income during the year, then you're required to file the IRS Form 1041 and the California Form 541 to report that income. And they call those fiduciary tax returns, and they've got a really high tax bracket that you reach the maximum tax bracket at 14,000, which is equivalent tax bracket for an individual of 335,000. This is an example of fiduciary accounting. This is not tax accounting. It does help get the records ready for income tax preparation, but the process of doing the accounting is beyond this course. I just pointed out that trusts and estates have to file a certain particular type of accounting reports that handles all the money that was on hand at the beginning when somebody was appointed as successor trustee, all the assets that came in, all the assets that were distributed, and the ending asset carry value, what it was worth at the time of the appointment, and then these numbers need to balance. This is an example of the same kind of court accounting for not using the court forms. These court forms, a GC 400 some, are judicial counsel, which means this particular one's required to be filed if any income is needed to be reported to the court. Okay, the due date on IRS Form 1041, fiduciary income tax return is 3.5 months after the year end. And what we try to do is distribute the income out to the beneficiaries so that the beneficiaries will more than likely have a lower tax bracket, and there'll be more money for the beneficiaries than if it's left in the trust and the higher tax brackets are used. So these are the numbers of the tax rate on trust and estates is 37% on the income above 14,000. Equivalent individual income before you get to 37,000 is 609,000. So we distribute the income to the beneficiaries to keep the tax bracket lower. When you're distributing the income to the beneficiaries, it goes out on an IRS Form 1041 Schedule K1, so the individual beneficiary knows what to report on their personal tax returns. And the trustee executor is allowed to make a distribution and backdate it up to 65 days after the year end. And it's still becoming a deduction on the state income tax return for the year, the prior year. In the final year of the estate and trust, it's marked off on the tax form stating that it's the final tax return, the final 1041, the final K1, and then no further IRS communication is necessary. Because there's two tracks, when an individual dies, it creates an estate. When a trust maker or settler dies, it becomes an irrevocable trust. They're both separate legal entities, both of which, if they have income, need to have a federal ID number. But the IRS allows for what's called an administrative estate under IRS Code Section 645. And with that election, you take both the income from the estate and the trust and ignore the distinctions between the entity and only prepare one tax return instead of two. Definition of in-kind distribution: it means a distribution of assets, not cash. So a house, apartment building, jewelry, a grand piano, anything with value directly distributed is called an in-kind distribution. The purpose of the in-kind distribution, one is to keep the asset in the family. The other is avoiding capital gains from sales. And we talked about real estate being important to get an appraisal, but it's also very important to have security also be valued as of the date of death so that the beneficiary knows what their tax is. And with stock brokerage accounts, we recommend clients work directly with the stockbrokers to get a market value on all securities within each account as of the date of death, because if the stockbroker does not step up the basis to the market value at the date of death, the brokerage house might end up reporting a large capital gain when there is none. So we recommend executors and trustees to take an active part in making sure that the brokerage account values have been increased. There are times when people want to avoid inheritance tax, want to avoid probate, and they put their cash accounts, life insurance, and other assets transfer on death directly to a beneficiary. We are hesitant to do that very frequently because it takes money away from the trust that's needed for estate administration, and that can cause cash flow problems. So we try not to use extensively the transfer on death accounts. I always get the question from beneficiaries if when I receive my inheritance, is it taxable? Because they always assume that inheritance is taxable to the beneficiary. And the answer is no, it's not taxable. There's no estate tax to the beneficiary on distributions. There are exceptions. In the rare case that inheritance tax was due and the property was distributed without paying the inheritance tax, extremely rare. There's there's a difference between an estate tax, which is assessed against the decedent's estate, and then an inheritance tax, which is due from the individual beneficiary. It's a minor distinction, but it exists. And in California, there's no estate tax nor inheritance tax. Some exceptions to the inheritance being taxable rules: if you inherited a pension or an IRA that had tax deferred money within the account and you receive it as a beneficiary there's called a beneficiary statement with the vendor who holds the IRA or the pension. When that money's received, it's taxable to the beneficiary because it was never taxed before. Oftentimes when an IRA or pension is distributed to a beneficiary, the beneficiary might consider not taking the money out, setting up and keeping it within tax deferred rollover into another IRA or pension in their own personal name and not paying the tax now because it's not a distribution. When the money is taken out, then it will be taxable, and the IRS rules now are that you have to take money out of a pension, an inherited pension or IRA, and you must empty the account out before 10 years pass. Roth IRAs, if those happen to be inherited and the account was in existence over 5 years, then the money coming out of the Roth IRA is not taxable, which is opposite of the normal IRA, individual retirement account and pension rules that are taxable. Other forms and procedures. There's an IRS Form 56 to notify the IRS that a fiduciary relationship exists with a trustee or executor, that the IRS needs to deal with you. There's an IRS Form 1310 where we've done a decedent's final income tax return and there's a refund coming. You need to attach a 1310 form to tell the IRS that you're going to follow the rules for distributions. And sometimes we run across individuals who have died and they haven't filed tax returns for several years. Those have to be filed by the successor trustee. And one way that we facilitate that oftentimes is we use an IRS form 4506T as in Tango, and we request the IRS computer records for all the 1099s and W-2s that the decedent had received in each tax year that we need to prepare. And that gives us quite a bit of information to be able to prepare and file those missing year tax forms. The 1310 statement of a person claiming a refund from a decedent. This is a simple form, IRS form 56. Notice concerning fiduciary relationship, the trustee and executors in charge now. This is an example of limited liability companies when they own real property. And as I mentioned, when you change ownership on real property, it's reassessed for tax purposes up to market value. If an LLC owns real property and the owner dies, then the LLC needs to advise the franchise tax board that there's a transfer of ownership, and that gets reported within the LLC. And if that is not reported, then there's no statute of limitations for the increase in property tax. And the franchise tax board can go back as far 10 years or more to collect tax when there was a change of ownership and the assessor did not know about it. On that California Form 568, you would include the form Schedule B, Board of Equalization, Schedule B, showing how the property transferred so it can be reassessed. For inherited IRAs, if you withdraw the money, you roll it into another IRA, you have 10 years to take the money out of the account and pay tax on it. A spouse can roll over the account without the 10-year distribution rules. However, if the decedent had they were over 72 years of age and they had a required minimum distribution rule that they had to take out a distribution every year or get penalized, then the inheriting beneficiary will also have to keep taking out that required minimum distribution every year. In California, there's a thing called a transfer on death deed. It's designed for low-income individuals who perhaps couldn't afford estate planning, and when the owner of the property dies, it transfers on death. It's similar to a transfer on death account for bank accounts. The transfer on death deed does avoid probate, but there's a huge problem for the beneficiaries, and I don't recommend using transfer on death deeds in California. The problem is the beneficiary will receive the property, let's say a house, and they will also become personally liable for all the unsecured debts of the deceased person, which is a horrible result. Your parent died, you receive a house, and all of a sudden, all their credit card debt, you become liable for it. We won't use them in our office because of the downside. A fiduciary needs to keep all of their funds because they're managing the funds for beneficiaries, and you have to put it into interest-bearing accounts or the fiduciary or trustee can become personally liable for the interest because they did not follow the rules. So the fiduciary has a duty to manage assets prudently. That's not making risky stock investments or personal liability can exist. Some of the questions, where are capital gains taxed in a trust? In a trust, when there are capital gains, as I mentioned, we try to distribute all the income out to the beneficiaries. However, when capital gains are on the estate tax returns, you cannot transfer the capital gains out to the beneficiary. They get taxed, and they don't end up being passed to the beneficiary on Form K-1 unless it's the final year of that estate. What are the rules regarding a Roth IRA being distributed? If the Roth IRA has been in existence over 5 years, this is a tax-free kind of IRA, then the beneficiaries also do not have to pay tax on that income. So if you have any questions, please write them out in the chat. And if you have questions, you can call our office. Our phone number is 925-934-6320. Our email address is info, I-N-F-O, at rexcrandell.com, REXCRANDELL.com. If you have any questions, I'll be happy to handle them. It might be better to send them first to our office in email. Thank you for attending and have a great day.